Hello and welcome to another Wealth of Advice market update recorded for you on the morning of Friday the 5th of July 2024. Everyone woke up this morning with a new Prime Minister, Keir Starmer, in charge of our country now. Labour Party had quite a resounding victory. As you can see, this was taken from the BBC website a little while ago, and it shows that Labour have already got a big majority there. Conservatives expected to have 119 seats, which I think is the lowest number of seats they've had in over 80 years. Liz Truss lost her seat last night. I must admit I did raise a little smile at that, because obviously what her period as Prime Minister brought in with Kwasi Kwarteng as the Chancellor was quite, well, to understand, it was one of the most volatile months in UK government bond markets in 300 years, what they did with UK government bonds. So we're hoping that this new Labour Party regime that comes in is not going to do anything as mental as what happened in that September of 2022. We're hoping during Labour's first 100 days in government that they're going to do the things they've said in the manifesto, and then, as I say, we look forward what will happen in the budget, what will happen with capital gains tax, what will happen with the personal allowance for income tax, what happens with pensions. So please be rest assured that we will be obviously watching and reading everything as much as we can, and if there's anything that would affect clients, we'll obviously be in touch and let you know. Bloomberg was commenting straight away that the Labour victory had no real impact on the value of the pound. It wasn't like this was an unexpected result. This result had been priced in for a while. But what obviously Bloomberg analysts were saying was that you want to see the UK kind of change direction a little bit, so that we have some positive legislation come through to try and get trade going again with the EU, for instance. The biggest issue the Labour Party have is obviously national debt as a percentage of GDP. How they're going to sort that, get that under control. They're saying that they're going to do any more borrowing. The chart that you can see on the screen now shows that Keir Starmer does have a much tougher job on his hands than what Tony Blair had when he came into power in 1997. NHS waiting lists, tax burden, national debt, net migration, first-time buyer, house price ratio. It all does look like a big task that they've got on their hands. So we now have to see what happens next. It doesn't feel like that morning of 1997 when Tony Blair won. Obviously, everyone was rejoicing in the streets, so to speak. The things can only get better anthem was blasted out everywhere. This one seems a little bit more calm, because I think everyone appreciates the job at hand. But so much has happened over the last 15 years under the last Conservative government. We had austerity measures at the beginning after the financial crisis. We've had COVID, we've had Brexit, obviously, war with Ukraine and Russia, China, trade wars. There's been so much going on, so let's just keep an eye on it, and as I say, be rest assured that we are monitoring investments all the time. It has to be said as well, there was a client rang me yesterday and was asking about how this might affect investments. Markets have been quite flat this morning, but most investment portfolios don't have a huge amount invested in the UK stock market right now. I was saying to a client just the other day, if you go back to 2003 when I first started giving advice, if you had 50% of your portfolio invested in the stock market, probably 40% or 3/4 or more of that investment in the stock market would be in the UK, a little bit in the US, a little bit in Europe, maybe some in Japan. Now the UK doesn't rank in probably the top 3 or 4 areas where money will be invested. Hopefully that will change, but we shall see. Let's keep an eye on it. Let's be positive. There's been some change in the last 24 hours. Nobody can disagree that the last year or so it's felt like a zombie government that's been in charge. There's nothing really positive happened, so let's be positive going forward, and let's look forward for the future. So the S&P 500 has gone up 5,500, the record high levels. Markets across the US holding up very well. There has been a little bit of volatility over the last few months, no getting away from that, but markets are really high. Any client that's coming to see us right now, we're looking at annual return figures really positive, and it's a good time to be having those annual reviews. It's much better than obviously what it was 12 months ago, so we're really happy with that. The Magnificent Seven, as they were called, the big technology companies, is what drove the market up in the first half of this year. We're now hopefully going to start to see the smaller companies, and when I say smaller companies, they still could be worth $1 billion or whatever. They're still big companies, but not as big as those 7 sort of monster stocks. Their share price of the smaller ones should do better if interest rates come down. The Bank of England said on its last last interest rate meeting that it does expect to bring interest rates down maybe August or into September. Why is that? UK headline rate of inflation is now back to the 2% target. First time we've been back to that 2% target since 2021. Again, you speak to people, clients, speak with friends, family, whatever. People still feel that we're living in a high inflationary time because people still have it in their head that everything they're buying now is more expensive than last year and the year before. But the fact that prices haven't gone up by more than 2% over the last 12 months is definitely a positive. Energy costs have come down. Major sort of components of what caused inflation is now under control, and hopefully that's a positive thing as we move forward. The Bank of England interest rate at the moment is 5.25%. There is that hope that they do bring it down, and you're looking at maybe a 1.25% reduction by the end of this current sort of cycle. That was what they were talking about last month. Across in America, their headline rate of inflation fell to 3.3%, which I know 2% is the target that all world banks, central banks want to achieve. But 3.3% in the US is really good. You've got to remember in the US, most of their people who have mortgages have them on 10, 15-year fixed rate deals. So although the interest rates have gone up, it's not actually costing their consumers much more, homeowners much more to pay the mortgage. So as wages have increased over there, they've still been able to go out and spend a lot more. And that's why their inflation has remained higher. The Federal Reserve Chairman said in November that interest rates would come down quite aggressively in 2024, and that's why markets surged up. They haven't reduced interest rates yet, but markets haven't gone down. So again, when they do finally get around to reducing interest rates over there, you would expect things to pick up. We obviously have to mention what's going on in their US election, which will be around in November. President Biden did an absolutely disastrous presidential debate last week with Mr. Trump, and a lot of people are calling for him to stand down. Is he too old? Does he know what he's doing? You listen to Trump speak sometimes and you wonder, does he know what he's doing and what he's saying? So in my opinion, standing 4,500 miles away, it looks a bit of a mess. Clients will ask, what difference will that make to markets? We spoke with the US fund manager a few months ago, and he basically said, forget the name Trump, but if the Republicans come in, Republicans will typically be good for markets. Democrats have got the economy working well, markets have responded well, so we don't expect anything negative really to happen depending on which party wins in November. So we now come to that part of the market update when we look at how markets have performed. Obviously the best one to look at is year to date, so from January the 1st to the end of June, markets have done fantastically well. S&P 500 they're up over 16.5%, FTSE 100 up almost 8%. When we extend that over 12 months, you can see S&P surging ahead. Mentioned those big 7 technology companies, your Microsoft, your Apples, Google, they're the ones who are surging that ahead. FTSE 100, which doesn't have those companies, still done 12.95%, which is definitely acceptable, and we're happy with that, and we're hoping markets continue to rise from here. You look at that 5-year graph, and you shouldn't wish your life away, but we're getting closer to that COVID drop-off kind of disappearing out the back end of that 5-year chart. But even so, anyone who's been invested for the long term can clearly see that you remain invested, hold your nerve through those volatile times, and you come out the other side and markets will go up and your fund values will go up. And I mean, when you look at that graph, the ups and downs on it, it's definitely been one of the most volatile 5-year periods that I've ever worked through. So thanks again for listening to another Wealth of Advice market update. I hope you're all feeling confident about the future. Let's see what the Keir Starmer and the Labour Party can deliver going forward. But I'll be back next month with another update and keep you hopefully informed as to what's going on with markets around the world and reassure you that everything's looking okay.